Welcome to part 3 of this trading bootcamp, complete trading course to teach you how to trade. Now, in the previous 2 lessons, we looked at the introduction and our goals and our objectives, and we've also looked at price candles, okay, how to read a price candlestick and how to read a price chart. Now, in this lesson, we're going to dive a little bit deeper, so let's get stuck into it. Now, we're going to look at some really important concepts in this lesson, okay, market dynamics. So what does that mean? Okay, so we're going to look at a thing called the fractal nature of price. Okay, we're going to look at the 2 main different order types in the market and understand how they move the market. We're going to look at the market dynamics, okay, so ranges versus trends, the market environment, balance versus imbalance. We're going to look at this. Then we're going to look at swing points and market structure and understand how we can use that in our trading. So let's get started. And firstly, let's look at the fractal nature of price. Okay, so this is a really important concept to understand, and it stretches your brain a little bit. Okay, but essentially we see the exact same things happening on the higher time frames as we do on the lower time frames. Okay, so whether we're viewing a chart on the daily, the 4-hour, the 1-hour, the 5-minute, we're actually looking at the exact same price action. We're essentially just zooming in further. Okay, so an example of that would be, let's imagine that this is daily price action. Okay, so we see a push down, a single push up, a push down, a push up, and a push down. Okay, let's just say it's daily. It looks quite simple. It's quite clear. But if we look to a lower time frame, say the H4, we would see pullbacks in here. Okay, so even on the daily, it looks like a straight push. On the H4 chart, the 4-hour chart, we would see pullbacks like this. Now, if we were to drop even lower and go to a 15-minute chart, we would see all sorts of pullbacks in here. Okay, trends up and down. Right, so this is really important to understand that as we zoom in on price, we're looking at the same price action. We're essentially just taking a microscope and zooming in further. So if we were just to look, on a 15-minute chart and look at this bit of price action, it would look like we're in an uptrend. But when we zoom out on the daily, the context of everything is we're actually in a big sort of bearish trend, pushing lower, and we're just in a little uptrend. Okay, so I know that drawing is pretty messy, but it's really important to understand that you're looking at the exact same price action. You're essentially just looking at it from a more zoomed in microscopic view. So that's why we always do top-down analysis. Okay, we start on the higher time frames first and work our way down. So really good example of this here. Okay, so we're looking on Euro USD, Euro dollar. Okay, like I said, it's really irrelevant of the chart we're looking at or the asset. The same concepts apply. So I'm going to take this bit of price action as our example. Okay, you can see here I've got the neutral colors of my candles, but this is a big sort of push down in price on the daily. And when we look on the daily, it's just it's a straight line, isn't it? Really, there's no major pullbacks. We've got some little spikes here, but really, it's just one significant push down. And this is why it's so important to start on the higher time frames, work your way down with a top-down analysis. So let's look at this exact same bit of price action right here. And this time I'm going to go to the 4-hour chart. So we're going to come up here. I'm going to select 4-hour chart. We obviously need to zoom out a little bit. And we'll get rid of this heading. Now, we're looking at the exact same price action, but we're starting to see some more details, aren't we? Right? So on the daily, this was just a absolute straight push down. Now we're starting to see, a few pullbacks, a few little uptrends. Here we, sort of broke structure to the upside and started moving up, then another big downtrend. We're sort of ranging through here, bit of an uptrend here. So this is when we're starting to basically use our magnifying glass and look lower into the charts. We can go one step further. So let's look at this exact same bit of price action and we go 15-minute chart. I'm going to have to zoom out quite far to see it. We'll sort of go through it and work our way down. So this is that whole bit of price action that we saw on the daily, now on the 15-minute. And if we zoom in and work our way down, we can see it looks completely different, doesn't it? We are seeing all sorts of things. We've got ranges, impulsive moves down, big trends up, big pushes down, more ranges. We're seeing everything, okay? So this is what you really need to understand, that the fractal nature of price is why it's so important to start on the higher time frames, zoom out and work your way down. Okay, you do not want to start on these lower time frames because you start just in here on the lower time frame. You're looking at this bit of price action and you think we're just in a very strong bullish trend. But when we look at the bigger context location, the 4-hour and the daily, we're pushing down. We've got opportunities to short at these SR and supply levels, which we'll get into later in the course. But that is the fractal nature of the market. Okay, then we go back out to the daily. and we remember what we're looking at. Okay, we're looking at this simple straight push down in price on the daily, which when we start looking at the lower time frames, this is definitely not a simple straight push down. So it's very important to keep this in the back of your mind, be able to view a daily chart and then view lower and lower time frames and still have a really good understanding of context of the overall picture and everything we're seeing in the market. Alrighty, now we're going to look at order types. Okay, so we're going to look at the two main different order types that get used in the market. We're going to look at how they're different and how we use them and how they affect price. Okay, so market order is the first order type we're going to look at. Okay, now a market order is a buy or a sell order to enter immediately at the best price. Okay, so you can just hit market buy or sell anywhere on the chart and it will enter you at the best available price. Okay, now technically or traditionally, market orders are used by smaller, more aggressive traders. And there's some negatives with a market order. Your fees are going to be higher when you're trading with a market order, and you're going to get more slippage because it's going to have to move to meet you on the other side of the order book. Okay. Whereas a limit order is a buy order below current price or a sell order above current price. Now, this is used by larger, more patient traders. Now, limit order is essentially where you're leaving an order in the order book and waiting for price come to you. So let's look at diagrams. Okay, we'll start with the market order. So market buy. Okay, let's just say price is moving in this direction. You expect it to go higher. You hit market buy at this point. You're obviously hoping price moves in your direction. Same with the market sell. Price could be moving down. You hit market sell here. Obviously, you're hoping price to go lower. And you can actually do it in the inverse as well. Okay, you can actually have price coming down. You can hit market buy here, hoping that it goes up. And the same here, price could be coming into a level. You hit market sell, hoping it goes down. Okay, so it's just hitting market buy or market sell anywhere where price is moving. And obviously you're hoping it goes in your direction. Whereas a limit order, okay, it's a buy order below current price or a sell order above current price. Now, this is the most common order. You're going to have less slippage, lower fees, and you're going to be easier to fill bigger positions. Okay, so essentially imagine price is up here. You put a buy order down at this level. You're hoping that price comes in, touches your level, and moves to your target. Okay, and then limit sell, order above price. So you place this order when price will be down here somewhere. You're hoping price comes into this level, touches you in, and then moves in your direction. Okay, so essentially think of limit orders as like the big orders that are waiting to be filled, and they really absorb price. Okay, so a limit order really absorbs price, whereas market orders are what moves price. Okay, once it's already moving in a direction, those aggressive market orders are what keeps pushing price in one direction because it has to keep finding other orders to fill. Okay, every order has to be filled with an opposing order. Okay, it's not like going into a shop where you just buy something off the shelf. Trading is literally trading. Okay, so every time you hit a buy, your buy order has to be matched with another sell order. And the same when you hit sell, every time you sell, your order has to be matched with a buy order. So obviously price is going to have to move to find somebody that's willing to sell it to you or buy it from you. All right. So order types are extremely important to understand. And the two main types we use in the market will be our limit order and our market order. All right, now it's time to look at some market environments. Okay, and essentially there's two main types of market environments. There's ranging and trending environments. Okay, and we can look at a ranging environment as balance. Okay, it's equal balance between buyers and sellers, meaning price will range. Whereas we have a trending market, which is an imbalance between buyers and sellers. Okay, in this example, there's more buyers than sellers in the market, which is driving price higher because we know we have to match those orders. So it's going higher to find willing sellers to match with the buyers. Whereas we're in balance, essentially we've got a sort of even number of buyers and sellers. They're essentially agreeing on price. We can see this as fair value, or when we're moving in a trending market, either up or down, we have an imbalance. We either have more buyers or more sellers. So price has to move higher to match those buyers because we know every order has to be paired. Okay. So we hear a lot of people talking about trends in the market, bullish and bearish trends, but essentially the market doesn't really move in beautiful, pretty patterns like this with, higher low, higher low, higher high, higher high. So I'll talk a little bit later how we can sort of use market structure in our trading. But essentially for me, it's more understanding the environment we're in rather than looking at the chart and going, okay, this is technically bullish based on higher highs and higher lows. Okay, because it's about perspective. Because we know in the fractal nature of markets, right, we could have a trend like this on the daily, but we know on the lower time frames, it's going to look like this. Okay, it's going to have uptrends, downtrends, it's going to have everything in between. Okay, it's a shocking drawing, but you get the picture. Whereas, the market doesn't move in nice, pretty trends like this with perfect highs, perfect lows. Essentially, the market ranges between imbalance, balance, maybe have a little bit of a trend, the down, balance. It looks more like this. Okay, that's the reality of the markets. We don't see textbook price action very often in the market, and it's very, very rare. Okay, so we need to understand the context of we can be alternating between a ranging market and a trending market all of the time. And it's really important to understand the context of the time frame we're using and the type of trades we're looking to take. Okay, so when we're in a ranging environment like this, okay, the highest probability trades are going to be at range high and range low. Okay, looking to short the highs and long the lows, because when we're in a range, all right, we can just mark this out. When we're in a range, we need to assume price is going to stay in the range until it no longer doesn't. Okay, it's the break from balance. So when price creates a range, and this can be on any time frame, we need to assume that price is going to stay rotational. So we can look for deviations at the high, short back to the low. Same with the low, we can look for deviations at the low, long back to the high. Okay, we don't want to be looking for longs here, essentially to range high resistance. Okay, so if we're pushing up like this, this is not a great opportunity to long, even though we've got some sort of lows here to trade from. We want to be looking for shorts at the highs and longs at the low is the highest probability trades when we're in a ranging balance environment. Okay, and then when we're in an imbalance environment and we're trending, we've got two options. Okay, we can go with the momentum. Okay, if we're pushing off in this direction, we can look for pullbacks to look for long opportunities, or we can wait until we come into a strong resistance level. Then we can wait for like a breakdown in price up here for shorting opportunities. Okay, so we'll look at more of that in the next couple of slides, but essentially it's very important to understand the two types of market environments we're in. We're in balance, so we're ranging, or we're in imbalance, we're trending. And it's important to understand why we're in imbalance. Okay, it's imbalance between buyers and sellers. One side of the order book is more aggressive, so price is having to move to match all those buyers with sellers and all those sellers with buyers. All right, now it's time to look at a 3-candle swing, or we can also call this a swing point. Okay, we can use this to help understand strength in the market. We can also use it to map some market structure. And I'll explain to you how I actually use market structure in my trading. And it's not to map the market as technically bullish or bearish, but it's to look for breaks in structure which signal potential reversals in the market. Okay, so what is a 3-candle swing or a swing point? Okay, so the first one we'll look at here is a swing high. Okay, so imagine price is moving in this direction and it moves back in this direction. So this is the 3-candle swing here. And why we call it a 3-candle swing is essentially a candle with 2 candles to the sides lower than it. Okay, so this creates that 3-candle swing. So you got the highest swing point here, then you got a candle either side that is lower than it. Okay, so that's the swing point here. If this candle came up above this one, that's not a swing point. Okay, that's just consecutive higher candles. We're looking for a swing. Okay, and the deeper this swing is in price, the stronger sort of that swing point is, or that sign of reversal. Okay, so the high and then one either side of it a little bit lower. That is your swing high. Now, swing low, it's the exact opposite. Okay, we're looking for the low point, then 2 candles either side of it that are higher than that candle. Okay, that creates the swing low in price. Okay, low, high, high, that's that swing low. And like I said, the deeper and more aggressive this is, sort of the stronger the sign of the reversal is in the market. So let's have a look at how we can use these swing points in our trading. One of the strongest ways we can use these 3-candle swings in our trading is looking for a thing called a market structure break, or an MSB. Okay, so this can be our first sign of reversal in the market. You can use this as an entry trigger in the market. We can also use it as a bias in the market. Okay, now these market structure breaks happen all over the chart. Okay, I just want to say that from the start. These happen everywhere. The most important thing to do is find them in a context and location where we think a reaction or a reversal in the market or a continuation might be likely. So let's just say that this is an area in price that we're interested in looking for some shorts. Okay, for whatever reason, and we'll get into it later in the course, this is a supply zone, it's a resistance zone, whatever it is. We're looking at the market, we've assessed that potentially if price comes into this level, we're looking for a reversal. Now, one of the things we can look for a sign of reversal is waiting until a swing point is broken. Okay, so let's say this is a 3 candle swing. It's a swing low, price pushed up, came down, created that swing low here, continued pushing higher. Okay, so essentially this is the low that caused this high. Okay, so the buying that stepped in here was enough to break this 3 candle swing here and push higher. So essentially this is quite a strong low in the market because it had enough demand and momentum to push and break this 3 candle swing right here. Okay, so then when we push against it the opposite direction and we close below it, this is showing us that the sellers here was much stronger than the buying here. Right, so this is showing us that there's a shift in the market structure. We've broken structure to the downside. So we can potentially look for a retest of this, and this can be our opportunity to get short. We'll look at entry triggers later in the course, but this is how we use market structure. Okay, we're looking for a low, creates the high, and price comes back, closes below this market structure low. We can either use this as an entry trigger, or we can use it as a bias in the market that price is likely to have a reversal. And then we can use all of our technical targets to look for our next trouble areas down here. Okay, now let's have a look at an example on the bullish side. Okay, so we'll just make this green, just give you a bit of an understanding. Let's just say this is a level in price that if price comes down to here, we're interested in buying if we see what we need to see. So what we see here, we see a low, push up, then we see a lot of selling here, pushes price below this level. Okay, all the selling here pushes price below this level. Then we see buying step in at this level and it pushes price to close above this level. Very important to close above it, not just wick it. We close above this 3 candle swing, market structure break. That is that sign of reversal in the market. So we can potentially look for a retest of this level. And that is our continuation here, either using this as a bias or potentially as an entry trigger. So 3 candle swing, very, very important to use them in the right context, in the right location. Okay, so we're looking for those 3 candles. Like I said, the deeper this swing point, the stronger it is. Then we want to be looking for these 3 candle swings in high probability locations, and we stack them with the rest of our analysis that we're looking at throughout this course. We can use this for our entry triggers and also our bias. So any questions, drop it in the comment section below, and I'll see you in the next video in the Trading Bootcamp series.